The idea. You still have a day job. The laptop on your kitchen table runs two tabs at once. The one your employer sees on calls and the product you are actually building. You give 2 weeks notice on a Tuesday and watch the last paycheck land in a checking account with $41,000 in it. That number is your runway. At $2,000 a month in fixed expenses, you have about 20 months before the savings are gone. You have never felt this awake. The Bootstrapped Scrapper. The company bank account swings between $900 and $11,000 depending on whether customers paid this month. You pay yourself $1,200 a month, enough for rent and not much else. You moved into a cheaper apartment in the spring and got a roommate you rarely see because you are up until 2 in the morning writing code. Monthly recurring revenue, meaning the repeating monthly income from paying customers, sits at $4,000. It has been at $4,000 for 11 consecutive weeks. Every week you tell yourself the number is about to move. The first check. An angel investor, a wealthy individual writing a check from their own money rather than from a fund, offers $150,000. You sign a safe note, meaning a simple agreement for future equity that converts into actual company shares when a real priced investment round happens. 3 days after signing, the wire arrives. The company account has never held more than $7,000 at one time. Now it reads $157,000. You pay yourself a real salary for the first time, $48,000 a year. The investor is a real person who expects a real return on that money, and that wait does not leave. The Accelerator. Y Combinator accepts you. Their current standard deal is $500,000 for 7% of your company. The credential matters more than the cash. Investors accept Y Combinator companies at roughly 3 times the rate of average seed startups. You relocate to San Francisco. For 3 months, you attend weekly dinners with program partners who have evaluated more than 5,000 companies. They have specific questions about the things your metrics are not yet saying. The co-founder arguments happen in the car on the drive home. On demo day, the twice yearly event where each batch company pitches to hundreds of investors at once, you give a 2-minute pitch. 3 term sheets arrive in the next 4 days. The seed round. $2.5 million arrives in the company account. The median seed round in the United States in 2024 runs between 2.5 and 3.3 million. You are venture-backed now. That means a professional fund has made a legal bet that your company is worth $14 million today and will be worth far more in 5 years. You hire 3 people and sign a lease on your first dedicated office space. Founder salary moves to $112,000 a year. The cap table, which is the document recording every shareholder and their exact ownership percentage, shows your combined stake at 68% between you and your co-founder. The runway keeps you up at 3 in the morning, 18 months to show enough progress that the next round happens on terms you can accept. Series A, $15 million. The wire clears on a Friday. By Monday, you have a board of directors that holds the legal authority to fire the person running the company, and you are running the company. Board meetings happen quarterly and last 4 hours each. Your head of finance spends 2 weeks preparing a 40-page financial review before everyone. The first time a board member asks a question, you cannot immediately answer. The silence in the room lasts 3 seconds. You think about those 3 seconds for the next 6 months. The scaling grind. You have raised $65 million across 2 rounds. Monthly burn, meaning cash spent per month to run the company, is $2.4 million. You now decide how decisions get made rather than making them yourself. Your ownership has diluted to 29%. At the current private valuation, that stake is $43 million on paper, and you still cannot access any of it. 2 years ago, you did something called a founder secondary, meaning a personal share sale attached to a round. You sold $1.5 million of your own shares, and the cash went directly to your personal account. Your spouse cried when the wire hit the personal account. That is still the only real money you have seen from 9 years of building. Your oldest friend got married last spring. You did not make the rehearsal dinner. The unicorn. Your company carries a valuation of $1.2 billion. 1.3% of all seed-funded startups ever reach this. You have an executive assistant. Journalists contact you for comment on industry trends. You fly business class. Your paper stake in the company is 12% of 1.2 billion, which is $144 million. But investors in your company hold preferred stock, meaning they have a contractual first claim on any exit proceeds. That claim totals $240 million. It must be paid before common shareholders receive anything. Common stock is what you hold. An acquisition below 240 million pays you nothing at all. For common shares to pay out, the company must exit above everything that was put into it. 72% of founders at this stage report significant mental health impacts. The other 28% are not being honest about it. The exit. The acquisition offer is $250 million. You smile, say you need time to think, and then sit alone in the parking structure for 11 minutes. The investor claims sitting ahead of your shares total $180 million. The first $180 million of the sale flows to preferred shareholders before a dollar reaches common. The remaining $70 million goes to common shareholders in proportion to their ownership. You hold 22% of common stock. Your gross share comes to $15.4 million. Federal long-term capital gains tax removes $3 million. California state income tax removes $2 million. The wire that arrives in your personal account says $10.4 million. You spent 9 years building this company. Your PR team sends a press release that says $250 million. The $140 million gap is what the preference stack collected. And that was always how this math was going to work. Post-exit. The money is in the account now. The calendar is empty. The company and the team belong to someone else, and the decisions you used to make at midnight are someone else's calls. You have more money than you have ever had and no structure for a Tuesday morning. Studies of founders after an exit find that well-being drops sharply in the first months following. It begins recovering around month 5 and stabilizes near the end of the first year. Most start another company within 3 to 5 years. The startup was the operating system for their days. Without it, they do not know how to structure who they are. You are sitting in the home office, the one you finally renovated after the wire cleared. A LinkedIn notification appears. Someone just quit their day job to work on something. You remember $41,000 in a checking account. You remember the rehearsal dinner you did not make. You left something at every level on the way up. The money is real. So is the cost of every level you crossed to reach it.